I think there's a distinction between how much the economy can handle higher interest rates and financial markets. I think the economy is actually, I realize it's losing a lot of momentum right now. I forgot to mention this earlier. I think one of the big reasons for that is just how much wealth destruction that's happened. And you probably have seen these same images that I have, that this has been the greatest wealth destruction in the post-World War II period. It's exceeded COVID, it's exceeded the global financial crisis. So people have lost trillions of dollars, and when they lose trillions of dollars, they kind of hunker down.
Right, you get the negative wealth effect.
So that in that way, that's where I think that's not so much the interest rate rise. But you could say, well, it's collateral damage of the interest rate rise that's created this drag on the real economy. But I don't think 3% interest rates are really a big. I say 6% mortgage rates. Well, that is certainly going to hurt housing.
Right. I was going to say we haven't talked about housing, but when you talk about negative wealth effect on the consumer, that's probably the number one injury. Is if housing prices go down, then a lot of people feel a lot less wealthy.
And I think that's going to happen. I think you're going to see housing come down 15-20%. I think prices just got simply too high. But since we brought up that, go down that side road a little bit. Unlike 2007, when I was so bearish on housing, you haven't had the overbuilding, at least with single family. I think where the overbuilding has been recently, the last couple of years, is multifamily. I think that's going to be the trouble spot, particularly in some of the cities that are losing people. And I also think that's true of commercial real estate as well. And actually, it's been pretty amazing. When you think about Amazon and the comments they make, everybody thought distribution warehouses were invulnerable, and all of a sudden it looks like there's maybe a glut of those. And so, yeah, a lot of things going wrong. But I do think that the Fed, that they do have a big ace up their sleeve, and that's this $1 trillion worth of treasuries that they've got maturing. And I think what they could do is pivot more the way I mentioned, which is intervening in the credit markets if they get bad enough. And to be clear, I don't think 600 over on the junk bonds, which again means about a 9% yield, is there. But you start getting up to 11, 12%, I think the Fed will say, look, we're going to keep hiking, or maybe we're going to pause if it's 3 or 4 months from now. But we're going to do this for the credit markets. That will be an unexpected pivot, I would argue. And of course, it's the unexpected that could have the really big ramifications for the market. So that could trigger a rally. But I guess my best prediction, and that's all it is, or anticipation, is that for the next few months, it's going to be rough. It's going to be bargains galore. And I've always believed that where you make really good money is in markets like this. But the trouble is you lose at first. And this is what I think really hurts people in their ability to make money in the long run, is that they just can't take that near-term pain to get the long-term gain. And I don't see it glibly, don't say glibly, it's not easy, but I think if you go into the buying program with the mindset, I'm expecting that I'm going to need to buy more at lower prices. I'm fully prepared for that. I'm looking forward to that. That's what Buffett does. He's the master at that. That's why he's made so much money. But most of us humans, we're not wired that way. We want instant gratification, right?
Right. And it's so funny. And we talk a lot in this program how it's our emotions that are actually by far usually our worst opponent on the battlefield when it comes to investing, because they generally force us to make the wrong decision at the wrong time. And look, nobody wants to ride a stock to zero, like you're saying. But if you're a long-term investor, you should actually like the ability to buy more at better values. But Americans just hate that. We love to chase a stock that's going up, right?
Well, I think that's why you were asking me, where do we like, and I'll hammer again. I like the bond market in here, the corporate bond market. With it, it can go lower too, for sure. But when you buy a bond that's going to come due in a few years at a 7% yield, I mean, you can kind of put up with some price loss. And I do find that's what we did in the financial crisis, when people were just too terrified to buy common stocks, but they would buy bonds and they would buy preferreds. And so at least that's doing something. It's maybe not optimal, but it's better than just sitting in cash.
If you enjoyed this video clip, click here to watch another one you should like.